be delivering the brief today for the 10th of November morning briefing. So what we're going to be covering today is overlooking some of the volatility we saw yesterday in the US session, the factors that led to this, driven both by fundamentals and what I believe a little bit of technical and psychological trading, and then touch upon some of the comments being seen on the Brexit front, and then wrapping up the day looking at the data calendar ahead. We have some UK data of note coming in at 9:30, and then we have some important US sentiment data coming in the afternoon. And given the US equity move yesterday, I think that sentiment reading, being a preliminary number, is going to be of quite a bit of importance. Okay, so let's have a look at just quickly how the market responded yesterday and what did we see. So coming into yesterday, I think one of the first things that I noticed was the Nikkei, which was obviously down quite a considerable bit after making quite a lot of gains. And it's not a market I look at quite a lot, but I think the first thing I do in the morning is flick through the charts. And as I flick through the charts, just looking at some of your broader indices, I happened to stumble across the Nikkei. And if we had a look here, I think the first thing I saw was this massive tumble that we had seen, and obviously the market was talking about this and saying that this was largely due to a bit of profit taking, given the fact that we had traded at multi-decade highs. So some profit taking, we saw the market dump quite aggressively, ultimately finishing the day down nearly 3%. So that was something of note, but I didn't pay too much attention to it at the time. This is a profit-taking move. It makes sense after the equity market rallied so heavily. But this was something that was being spoken about on Bloomberg, as well as traders flicking through screens definitely would have sort of seen this. And then this led us into the European session. And the European session, what we started to see was we looked at the European equity market, and particularly the DAX. And I know a couple of the guys in the live room, mainly Inga, was mentioning this as well, and some of the guys in stage 2 were talking about this this gap that we had in the DAX, which, as we know, the DAX is quite an illiquid market, and therefore it does often have quite big gap opens, and therefore that leads to quite a good opportunity to sort of fill the gap. So people did come in on this, was on the 1st of November, saw this move higher, and we're expecting a bit of a retracement to either go test these lows or ultimately go breach it, but that didn't happen. On the 1st of November, the equity market sort of teared higher and sort of maintained those gains, consolidating around the top of its range. And what we saw yesterday was a few technical breaches as the market was coming under some pressure, and given the fact that we had that Nikkei profit taking, a bit of negativity, other Asian markets were down as well, and this is the sort of leads on to the importance of knowing what happened in the Asian session coming into the European session. We trade global financial markets, and sentiment can often be reflected from one session to the other. So seeing a negative day in the Asian sessions, that would have been helping a bit of negative sentiment in your products like the DAX, and ultimately breaching that S2 level, which defined the top of that range, and we saw quite an aggressive move then all the way down to fill that gap, and that took us all the way through to about 1 o'clock. So the move starting around 11 o'clock and filling the gap around 1 o'clock. And what's interesting about 1 o'clock now is that this is when the North American crossover starts to take place, and we start to see the Americans enter the market. So the Americans would have come in and they would have done their research. They would have seen Asian sessions lower. They would have seen big red candles in the DAX. We would have had the gap fill. Simultaneously, we're seeing a bit of weakness in the dollar against the euro over here. Euro strengthening against the dollar, allowing this to move just a bit higher. So then that led us into the US session, and following suit with the DAX, we're seeing the S&P move lower. So this is at the moment just talking about some trading psychology and a bit of behavioral finance, a bit of technical trading. We saw your US equity market coming under some pressure as well, really starting to gain momentum after the cash open, and particularly with the US, you can really see that this was due to a bit of pessimism about the speed at which the tax reform is going to take place. I think some of the most important points in terms of the US equity market would be the corporation tax, which, as has been discussed, is going to be cut to 20%. But this was sort of the timeline that markets were looking for, was the beginning of 2018, so basically the end of this year, start of next year, which is only about 2 months away, given the, well, a month and a half away. So what we saw in these plans, it was that this cut would be delayed by 1 year. So that sort of builds this negativity that is Donald Trump going to be able to deliver all of these fiscal packages, fiscal stimulus packages that he has spoken so highly of. And the market did. If it didn't believe anything, you know, there was some positivity with regards to this tax plan. But so that being delayed by 1 year was one thing which definitely helped this equity market move lower, coupled with the one-off tax for any offshore earnings. The number used to be around 10%, then it went up to 12%, and the market was a little bit disappointed by that. Now we're looking at a number around 14%. So there is going to be some delays in this tax reform. Now, in itself, do I think this is why we saw a huge sell-off in the equity market? I think it's one factor that helped it, given the Asian session, the European session, and then following suit into the US session. But what I have marked up here is the sell-off that we saw. So this is where the market opened, and we fell all the way to exactly 1% or 0.99% before we found support, also taking us to the bottom of the range. People finding this to be a little quick sale, and then we see the market sort of rally into it. But just looking at the equity space now, we are seeing some continued pressure in US equities. It seems more so at the moment than even in the European equities. So this may bring us into one of those interesting situations where we see the European and the UK participants start to sell the US equity market, leading into the US Open, and the US Open obviously come and buy it back. Is going to be, I think, the defining moment. And just on a note that the VIX only managed to close up just over 10, so your fear gauge is going to be is still reading sort of multi-decade lows. So it's not that the market's particularly frightened here, but it will be interesting to see how this price action changes over time. Do we see what we saw early on in this year, where European participants sell in to the US market, and then we see a bounce where the US participants sort of come in? We did see an element of that, but this was sort of delayed. The bounce in equity was after the Europeans went home and coming into the US close. I think the time where I'll start to be looking for more bearish entries on US equity will be when we don't see that bounce coming into the US or the end of the US session. It was a tricky session to trade. Yes, it was volatile, but there were other things we needed to consider. We didn't really see a rise in T-notes as we would see generally speaking. So this is my T-note charts just down here. Really capped by pivot. We didn't see that safe haven flow into T-notes, and gold, which, you know, as a market really can run. Let me just get a gold chart up. Especially when there are risk sentiments, gold should be is one of your leading gauges of this. What we saw here, chart loads, is that R1 actually capped the move yesterday. So I found this to be quite acidic when trading, where I was looking for that safe haven flow. And even when the equity market reverses, you can see gold really didn't do much. Now, to explain this, I'd say if everyone was here in the beginning of 2015, 2016, 2017 sort of time, where we had the Trumpflation trade, we saw that the dollar strengthened, yields rose, and equity rallied. That was your Trumpflation trade, sort of breaking any traditional correlations in the market with. So that would be T-notes, and so yields rising, equity rising, and dollar rising. But what we saw is in the bond market we had a full correction. The dollar fully pared back the gains that he had made coming into 2017. The equity market hadn't really done so. So the negativity regarding the Trumpflation trade had already been reflected in the bond market and the FX market well before yesterday. So anything, just a bit of profit taking us down to the bottom of the range. And I'd like to see a continuation of this. But at the moment it seems to be quite an interesting session already, with some really bearish candles here in the S&P 500, DAX coming under some pressure. So that wraps up yesterday's sell-off and sort of the reasoning behind it. Just on some other headlines. So this is just the dollar declining. we saw last night is the RBA sees solid growth but slow inflation, and they expect to see rates on hold. So we did see a reaction in the Aussie dollar. However, it wasn't particularly exciting, maybe underperforming just slightly on the session. So this is it coming out, and it takes us down to pivot. European markets drive it lower, but ultimately just took us from the top of the range to about the bottom of the range as we're trading right now. Just having a look at the Aussie dollar and the euro. Actually, the euro. Yeah. So there is a bit of underperformance here by the Aussie dollar following that headline. My apologies, I needed to transition. So this is the Aussie dollar with the RBA when there's sort of dovish commentary on future rate hikes weighing on the Aussie dollar. And in terms of Brexit, well, there have been a few things popping up on the Brexit front. We have the EU summit on the 14th to 15th of December, so not very long to go, actually just a month away. And at the moment, we're still in a stalemate. We've got UK presenting 20 billion payment, and the EU sort of demanding more 60 billion. So this is not looking too great, given the fact that Theresa May, there are reports saying Theresa May is looking to make significant adjustments to the amount that she's willing to offer, which would be expected. What was the other choice that we had? Go into the EU summit on the 14th, 15th December, coming up to the end of the year, and have made no progress whatsoever. So we're in a situation of stalemate. Somebody had to give, and it does seem like the UK is the one that's going to sort of give. So on the lower end, we've given an offer of 20. On the upper end, we've got 60 billion. Just of sort of note here, we had Sir Ivan Rogers, Britain's former EU ambassador, said last month that Britain might have to pay a further 30 billion if we were to pay for its 12 to 13% share in the EU's 240 billion euros of outstanding commitments. So this would then, so your mid is about the 30. I reckon the EU would be looking for a little bit more than this, and I think Theresa May will need to now sort of take charge and get a number out there so we can sort of move forward with these negotiations. So it's not just about making the offer. She needs to not just make the offer needs to be made, and then the European countries need to sit down, agree, and then once it's agreed, then come into the EU summit with hopefully a bit more positivity. But given the state of the Tory party and all UK political parties at the moment, we're not showing signs of strength, and I think if she can't clutch this situation soon, it's only going to become worse and worse and worse. If we continue to see this negativity in our political atmosphere, this then will throw up issues in the EU. Well, is Theresa May the woman, or is the Tory party the government that's going to lead us through the next 2 years? And if they start losing confidence on that, then what we may see is them starting to become less responsive to negotiations, waiting for our sort of political atmosphere to start to settle down before moving forward. Just on the commodities front, however, what I did want to talk about was transition my charts over. Oil has still been quite a volatile product. Well, it's always been a volatile product. What I mean is we're seeing this sort of unique volatility coming into the close, and we saw that yesterday sort of as well, breaking through pivot. And I think the Saudi Arabia situation with their corruption charges is further fueling this rise in the oil prices. But this is also given the continued growth we're seeing globally. Off note, of course, is the euro area, which is coming out of some of the worst of its financial crisis lows. We're seeing broad-based confidence in the eurozone, obviously being one of the biggest consumers in the world, and we're seeing sort of commentary coming out of COA saying we're now at a stage in the economic cycle where the recovery is strong. Constantia saying we're encouraged by the way the economy continues to grow, and that all new indicators, mostly so far, indicate that growth could be indeed stronger. So the global growth outlook, and we know that the United States growth is doing pretty well, so some of your biggest consumers in the world looking to continue to grow in the forthcoming years would then further fuel demand, which will then further fuel global economies, particularly in the developing markets where oil is still the cheapest and most accessible fuel available. So I know I have been calling a bearish view on oil. for a while, but that's perfectly fine. But you need to be understanding why we're seeing this move in the commodities space. In terms of our data calendar today, let's pull this up. So in the UK, we have construction output, industrial output, and manufacturing output. So these are going to be some key numbers, particularly given the fact that we are starting to see negativity seep into our economy as a whole post-Brexit. Now that it's been almost a year, well, about a year since the Brexit vote, we've seen the sterling come under pressure. We're seeing inflation rise and a decrease in average hourly, a squeeze on the consumer due to average hourly earnings not rising. Sentiment is still pretty low, so I feel like any sort of UK numbers are going to be particularly of interest. These aren't going to be as impactful as, let's say, our services numbers, but definitely to sort of keep an eye on. So we're looking at, for our construction year on year, 2.2 expected versus the previous of 3.5, so a fall there. Manufacturing output 2.4 versus 2.8 expected previously. Industrial output seeing a small rise from previous of industrial year on year, 1.9 versus 1.6 previously. So there's going to be some key data coming out just half an hour from now. Otherwise, data calendar is quite quiet until we get to about 3 o'clock, where we have US Michigan sentiment preliminary numbers. Again, I think with these numbers it's going to be important, and if anything this will allow us, the equity market, really to move higher, but these numbers have been tracking at very, very high levels. So in terms of what will be the bigger move will surely be if we get a disappointing number here. We're seeing confidence in the United States start to taper away. I don't think that's going to be the case at the moment. Sentiment is still higher. If anything, this whole tax situation would still take about a month to seep into US consumer confidence, but I think that's still, for now, still expecting a relatively high reading, expecting a 100.7 reading. So all eyes for that. But in terms of expectations leading into this number, a lower number for sure would allow the dollar sort of to continue to weaken, or equities particularly. Generally, I wouldn't like to trade US equities in the back of data. This is not me giving you a complete green light, but I think given the move that we saw yesterday, if we see Michigan sentiment being a very low number, then that may open up a bit of room for equities to move a bit lower. Otherwise, this afternoon we have the Baker Hughes rig count. We're seeing US output production ramp up to multi-decade highs once again. So it's going to be interesting to see if we start to see these rig counts continue to increase, which would then lead on to potentially some downside in oil. But at the moment, looking at the oil market, it's very solid. Nothing really coming up for resistance in the near term. Having breached that 55, we've just seen a one-way move higher, gone to test the 58, but really our next natural resistance line would be, so you handle 60, which hasn't provided particularly good resistance or support in the past. After that, 62.5 I'd say would be the next natural resistance line, if oil does continue its move higher. Okay guys, so that's the brief for today. It's going to be a quiet morning. Sterling has been sort of outperforming this morning, but that's to be expected ahead of UK data. It can be quite erratic. So 9:30 sterling, all eyes on sterling. Then going to 3 o'clock into US Michigan sentiment. Fridays as usual around 3:30, 4 o'clock. Market volatility will seem to taper away. So if you have any profits or if you have any losses, it's always good to start to sort of take a step back from the markets, particularly following a 3 o'clock US data release. Alright guys, thank you very much. I hope you have a great day, and I'll be in the trading room if you need me. Thank you very much.